Hi, I'm Scott Walker with Wealthcare Investments and Insurance. In a recent video, I discussed qualified investments. So in this video, I would like to talk about non-qualified or non-qualifying investments. Now, non-qualified accounts could be identified or registered as individual or joint accounts, certain trust accounts, Uniform Transfers to Minors Act known as the UTMA, or Uniform Gifts to Minors Act known as the UGMA, and there are other types of non-qualified account registrations. You can often have more than one owner in a non-qualified account. Now, non-qualified accounts do not have any special tax treatment, and there are no IRS rules regarding contributions or distributions. Non-qualified investments are funded with after-tax money, meaning that you have already paid taxes on that money. So going forward, you're only going to pay taxes on the gains from the investment or the account. In some cases, the gains could be tax deferred until you sell the investment or take money from the account. However, you might end up paying taxes on the gains on an annual basis if there are dividends and interest, or if you're making trades inside the non-qualified account, such as a brokerage account where you might have stocks, bonds, mutual funds, and other types of investment holdings. Now, it's important to know that non-qualified investments can also be precious metals like gold and silver. They could also be collectibles, artwork, jewelry, and other types of property owned. So in most cases, the gains are going to be taxed according to capital gains rules. There are short-term capital gains, which are investments that were purchased and sold within a one-year period. Short-term capital gains are treated as ordinary income. Long-term capital gains are investments that were held for more than 1 year. Long-term capital gains are subject to the capital gains tax rules, and currently those rates could be 0%, 15%, or 20% depending on your income tax bracket. So capital gains can be reduced by claiming capital losses. If you have investments that you sold for less than what you originally paid, you could use that to offset your gains, in which you get a net capital gain. Now, we've barely opened the door on everything that could be said about non-qualified investments. And remember that whatever the rules, there are always exceptions. And this is why it's so important to discuss your specific situation with a tax professional and an investment professional before you make any financial or investment decisions. So if you have any questions or comments, or if you would like to meet with us, please feel free to reach out to us. Our contact information is on the screen. Thanks for watching.